Do you want to know the secret leveraging technique that made Nancy Pelosi and her husband Paul millions of dollars in the market? Stick around and I'll explain what she does and how you can leverage the same trading strategies. I train elite seven-figure traders on how to use powerful techniques to take their trading to the next level. I'm building this channel for those of you who aren't seven-figure traders yet, but want to learn and implement elite strategies to optimize your returns on your favorite ideas while managing risk like a pro. The strategy Pelosi uses involves options. I'm almost certain that many of you heard from an average investment advisor that options are risky. They often say this because they don't offer the service to trade them, or they don't want the extra work of managing the expirations. If they were truly risky, why would Nancy be using them? So here's what she did. Between 2020 and 2024, Pelosi bought deep in the money call options on Apple, Microsoft, Nvidia, Broadcom, Roblox, Salesforce, and more. What the hell is she doing? Let's talk about options and how they work. Call options are the right, but not the obligation, to buy the stock in the future at a fixed price over a fixed period of time. If you want a clean and easy explanation of call options, click on the link where we'll take a deeper dive into this. So while Nancy Pelosi has done a whole series of these trades, I want to narrow it down and just focus on one for the purpose of explanation. Nancy bought 50 call options on Microsoft back on May 24th of 2022. Now she bought 50 calls at the strike price of $180 out to June 16th of 2023. So she had that right to buy the shares of Microsoft at $180, and she had an entire year of time to decide on this. The Microsoft stock was trading around $250 a share, giving her the control of $1.25 million of stock. Now, these options were $70 in the money. What does that mean? Well, she had the right to buy the stock at $180, yet it was trading at $250. This was 30% in the money. If you need a further explanation of the moneyness of options, click on this video link for a further explanation. Now, while we don't have the exact purchase price of Nancy's trade, we can calculate that the calls would have been around $75 a share or $375,000. So why the hell would she do this? Well, if you don't know the answer, that's why she's an elite trader and you need to take yourself to the next level. Many investors and traders use stock margin, but Delta One margining is for schmucks. Let me explain. Most stock traders can leverage on margin at 30% rate, which means to buy $1.25 million of Microsoft stock, they would need $375,000 of capital, and the broker would lend the remaining $875,000 as a loan collateralized by the shares. The risk being that the margin changes as stocks move higher and lower and investor equity fluctuates. This can lead to the infamous margin call, which can often lead to investors being forced to liquidate and often losing all their money. Many people buy options to speculate, but not Pelosi. Nancy bought these options as a risk control. Nancy put up $375,000 to control $1.25 million of stock, the same as the stock margin trader, but had zero risk of fluctuating margin and removed all risk of margin call. But what's the catch? What's the trade-off? Well, from a cost perspective, not much. She probably paid close to $30,000 to $40,000 of time value in these options, while $875,000 margin loan could easily have accumulated $30,000 to $40,000 of margin interest. Let's call it a wash. But to understand the risks, we have to talk about how markets work. Any trader worth their salt knows that bear market declines are an inherent feature of market cycles. You want to think of it like swells rising and falling in the ocean. As an example, Microsoft lost 65% of its value in 2000, 60% of its value in 2008, 32% of its value in 2020, and 38% of its value in 2022. Shit happens and it will happen again. The difference is Pelosi can survive and control her position during the decline while margin investors are being margin called. Now let's go through a couple scenarios 6 months into this trade. The easiest way to learn is to do a comparison. I have investor 1 and Nancy Pelosi is investor 2. Investor 1 goes out and outright purchases 5,000 shares of Microsoft stock. Position 2, Nancy turns around and buys those 50 call options at the $180 strike out 1 year in time. So when we look at the starting comparison, you can see investor 1 outlaid $1.25 million to physically own the shares. This is assuming that it's obviously margined. Investor 2, Nancy, puts out at $75 an option, $375,000 to buy the actual call options, which is controlling the same 5,000 shares of Microsoft. Now let's simulate a couple outcomes. The first thing I'm going to do is simulate what's happening about half a year into this trade. We're going about 180 days in. What you can observe is that Nancy has suffered about $15,000 of time decay on this position. Now, it looks like the investor didn't lose that, but this is where you have to account 6 months of margin interest, which would have actually been very similar in its outcome. So now let's go through a simulation of the fact that what the stock rises. And this is in fact what it did while Nancy owned it. It went as high as $360. So when Microsoft was at $360, how did our two investors do? Well, notice our first investor who physically owned the shares was up $550,000, and Nancy's trade was up $535,000. Now you can say, well, the stock investor made $15,000 more, but again, you have to account for the margin interest that has not been priced into this. So again, the key observation is that Nancy made virtually the same amount of money as the stock investor using the option. She didn't use it for the convexity or extra leverage. She simply used the option as a stock replacement to replicate leveraged margin. Now let's go through a scenario where the opposite would have happened. Let's just imagine that Microsoft dropped 30% and dropped it down to $180 during that same 6 months. Now what you can observe is the stock investor was down about $350,000. Now, if they were fully margined, they would have been experiencing margin calls and been liquidated on numerous occasions throughout this decline. So how did Nancy do? Well, she was down $325,000, not $350,000. But because she bought it to be like a synthetic stock position, it is going to have a similar style loss. But the key here is that she's not margin called. She isn't being forced out of her position. She has all of the ability to hold this position for a stock rebound over the following 6 months. More importantly, now with that option trading at $10, she could easily dollar cost average or double down on the Microsoft position, anticipating that rebound. And the last key observation to make is that what if this became even worse? Microsoft lost 60% of its value on numerous occasions. And so if that scenario was to ever repeat, that investor who owns the physical shares, the loss keeps getting worse from $350,000 to $450,000 to $550,000 and so on. While Nancy at this moment can only possibly lose $50,000 more. So she has all of these risk controls in place, managing the downside, but yet on the upside, she literally made all the same money. Point is, she didn't use the options for a long gamma convexity. She used the options to replicate stock margin. She got all of the leverage on the upside while losing less during a market crash and removing all risk of margin call. We'll take a deeper look into the strategy in another video. Thank you for watching, and we'll see you all in the next one. Cheers, everyone.